Eric Wiegand, it's been getting rocky in the market since Labor Day. You see the VIX, the so-called fear index, up over 20% since then. But you see stocks grinding higher. Why is that?
You know, there is normal seasonality that comes into play during September and early October. There's an absence of data for investors to deal with, contend with. So we're finally, focusing on central bank activity. That has created a lot of that volatility. Our grind higher thesis is really, predicated on a few things. Number one, we don't see, this being the data points being conclusive. Either conclusive that the economy is slowing materially, suggesting recession, or that we're seeing a rapid increase in inflation. This still kind of muddling along is what we expect to continue for the near term, and as a result, we think valuations with earnings starting to tick up in the third quarter and fourth quarter will likely have the markets grinding higher.
And which sectors do you like?
In this environment, we continue to like healthcare and technology. We're a little bit selective in the consumer discretionary area, but do think that there are opportunities there as well.
And what about the Fed? Can the Fed throw the market off base from your grinding higher thesis?
They certainly can. Our expectation is that during this meeting in September that we're not likely to see a material change other than posturing. We're not likely to see them raise rates at this meeting. If they were to, that would certainly be acknowledged as a surprise to the markets. But the economic reality is whether it's September or December, it's not likely to have that great of a magnitude of impact.
All right, what about the magnitude of the election? Is that a wild card or just wild?
Yes. Yes to both, no doubt about it. It's certainly interesting in that, from an election standpoint, you have two candidates that really aren't, held in high regard by the voting population. So a lot will depend upon the potential of coattails for either candidate, which we think would be interpreted negatively by investors. And certainly the likelihood that any policy changes of consequence, arise out of this would potentially be disarming to investors.
And then finally, let's bring it back to earnings, which is supposed to drive stocks. What's your forecast for third quarter earnings? Because we're almost there. And also, do you think we've been seeing higher wages? Do you think that's going to chop into margins?
Two things there. Number one, on earnings, we do think earnings will improve during the third quarter. Number one, they do have an easier comparison on a year-over-year basis. So we think we're finally at a point where we're close to seeing that breaking of that trend where we've seen negative year-over-year earnings comparisons. But we do ultimately think that expectations, particularly as investors look towards 2017, are still perhaps a little exuberant as yet, and we need to see that dialed back. With regard to, from a valuation perspective, we still think that valuation does give pause for concern, but in a low growth, low inflationary environment, having the multiples sustained at these levels, we think is accommodating and is certainly likely to be sustained.
All right, well, thanks a lot, Eric.
Greg, thank you very much.
And thank you for watching The Street.